Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time home buyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
Hello, everyone. Welcome back from your summer holidays. Hopefully you enjoyed some time with family and friends as we come back to September. Kids are back to school. Fall is in the air, and we're back with ICD.D with Dr. Sherry Cooper. Sherry, I hope you're doing well and you enjoyed your summer. I think we talked a little bit. It sounds like it was a good summer for you as well.
Yep, absolutely.
Awesome. Lots going on. I think no shortage of subjects to talk about. Unemployment ticking up, inflation ticking down, real estate activity slowing, U.S. elections coming, arrears picking up in mortgages with the banks, renewals and refis are all the talk. Variable versus fixed, which should you go? And then about an hour ago, Jasmeet Singh, the NDP leader, announced that he tore up the supply and confidence agreement, which could lead to an early election if non-confidence vote comes through. So we'll talk a little bit about that. We just sort of talked about it. We found out about it, but definitely a subject to talk about. But just a reminder, first of all, thank you, FCT, for sponsoring today's episode. Also, if you have questions, put them in the chat. I'll get to them as soon as I can. We do want to allow Sherry to completely finish her presentation, and we'll definitely get to your questions. So, Sherry, 2.25 decrease. That was something that nobody was surprised at. I think there was some fingers crossed for a half a point, but just didn't happen. What are your thoughts? Let's hear about your presentation.
Well, thank you, Eddy. Nobody really believed that the Bank of Canada would cut rates by the full 50 basis points. So, and in fact, in the press conference today, Tiff Macklem was asked if the Governing Council had considered a 50 basis point rate decline, and Macklem kind of ducked the question, but basically said no. So I think it's very unlikely that the Fed will cut interest rates by 50 basis points either, although there's a better chance of that given that the Fed has lagged the Bank of Canada than for the Bank of Canada to begin to increase dramatically. What they're clearly determined to do, which is to get interest rates down. Now, I want to start with my presentation. Yes, the Bank of Canada continued to ease monetary policy. They began this in June, did it again in July. Here we are now in early September, and I believe they will continue to cut interest rates at every meeting, at every decision date. The question mark, though, is Canada's soft landing I say it's a question, though I'm not forecasting a recession, because the Bank of Canada raised it this time as a question. They're very worried that the economy is weakening too much and that it could take inflation down below target. So in that regard, this was a very bullish statement by the Bank of Canada. The economy certainly has slowed. Now, the first half of this year, economic activity actually wasn't bad. In the first quarter, we saw 1.8% growth, and then second quarter 2.1. However, judging from the incoming data, I think there's a good chance that given how weak July has been, as well as parts of August, we're going to see about 1.3% growth in the third quarter, with an uptick to around the 2% range as we move into the fourth quarter and then next year as well. Now, as I mentioned, the Bank of Canada is concerned about too much of an economic slowdown, too much excess supply. When you look at our growth rates, yes, the economy is still in positive growth territory, but on a per capita basis, we have seen a consistent, substantial decline in real GDP per capita. So it's little change from a full decade ago. GDP per capita growth has fallen for 5 consecutive quarters. And I put the US on this chart just so you could see that it is not happening there. It is a Canadian phenomenon as a result of better than 3% population growth in this country. Canadian consumers are far more interest sensitive than US consumers for obvious reasons. Our mortgages have a term of generally no longer than about 5 years. And so people, given that there's roughly 70% of outstanding mortgages up for renewal or refinancing in the next few years, everyone is subject to increasing monthly payments, and that slows growth. And here you can see that mortgage debt servicing relative to disposable income is much higher in Canada than in the US, where there are 30-year fixed rate mortgages. So it's not surprising then that the Canadian economy has underperformed the US. It's underperformed by a full 10%, which is very high. The underperformance of Canada is particularly in the demand for services and government spending. Q1 saw the biggest gap since 1965, and that's why we began to cut interest rates well ahead of the United States. Our labor market has slowed considerably. The unemployment rate now in Canada is at 6.4%. The US jobs data just finally showed an uptick in unemployment. So again, the US is stronger than Canada, and their easing will begin at their next meeting, which is September 18th. Could be 50 basis point cut, but certainly we will see a cut of 25 basis points at least. Now, looking at Canadian job growth, you see that in June and July, we had virtually no net new jobs. In fact, there was a small negative in the employment data, which the Bank of Canada is concerned about. The working age population has grown much faster than employment in the past year. Average employment has been under 30,000 per month in terms of new jobs, where the labor force growth has averaged 54,000 per month. Hence, we see unemployment rising. So unemployment is 6.4% in July, the same as it was in June. this will eventually put downward pressure on wage inflation, wages being a lagging economic indicator. We also see that job vacancies have fallen considerably. They're back to where they were pre-COVID. And that's another example of excess supply in the system. And when job vacancies come down, typically they lead inflation down. And we've certainly seen that this cycle. Depending on how you measure wage inflation, right now it's around 5.2%, which is certainly higher than what the bank would like to see. But as I said, it's a lagging indicator. It will come down. Other measures of wage inflation have already come down. If you correct for the type of job, you see that inflation is running closer to 3% in terms of wages rather than 5.2. And unit labor costs are rising because of very sluggish productivity growth in Canada. So for lots of reasons, the Bank of Canada would love to see the economy stabilize and growth to remain in around the 2% range, but I don't think that's likely in the near term. Now, the inflation outlook is quite good, and inflation has fallen now to 2.5% in July. Core measures of inflation are even lower still. So that is very good news. We've got the inflation low, but it's not just the measure of inflation, the headline measure, but Canadian inflation is below the US. Disinflation will continue given that the economy is in excess supply. And here I show you some other measures of core inflation that the bank monitors closely. And for both of these measures, the CPI trimmed mean and core inflation as well as the median core inflation. In both cases, those numbers are at 2.4% and headed lower still. When you look at the 3-month moving average and the 6-month moving average for these measures of inflation, those are both trending down now, which is exactly what the Bank of Canada wants to see. Only 1/3 of product prices are rising by more than 3%. So in other words, 2/3 are experiencing inflation well below 3%. And the one part that remains a problem is the inflation for shelter, which includes mortgage interest payments. Excluding mortgage interest, CPI inflation is only 1.8% year over year. In other words, below the target 2%. And in the opening comments made before today's press conference, Macklin talked about the risks of disinflation, the risks of the economy remaining too weak, and that inflation comes down more than target, which is destabilizing for the economy and could well lead to a recession, which the bank would not like to see. So the Bank of Canada today, surprising no one, cut interest rates another 25 basis points to 4.25%. Monetary policy is still quite restrictive because 4.25% is well above that 2.4% inflation number, and further declines are coming. I think that the Bank of Canada is not going to stop easing monetary policy until the overnight rate is about 2.75%, which will occur next year. But the bank is clearly of a mind that inflation is on a secular downtrend. Now, this just shows you the overnight rate relative to core inflation. Normally, we see over the past 30 years that the average real rate, meaning the inflation adjusted overnight rate, is just 60 basis points, 60. Whereas right now, the overnight rate is still 185 beeps above the current core CPI inflation numbers. So the overnight rate will continue to head downward. My forecast right now is for 2.75%, but if I'm wrong, I think we'll get to 2.5%. Remember that prior to COVID, the overnight rate was a mere 1.75% and fell to 25 beeps as we moved into the pandemic. That isn't going to happen again, but we are seeing a push for lower interest rates. Now, with the overnight rate at 4.25%, the prime rate is slated to decline probably this week to 6.45%, currently at 6.7%, which means we'll see a decline in floating rates with this Bank of Canada rate cut. So both adjustable rate mortgages and the variable rate mortgage rates will continue to fall. Now look what's happened to the 5-year bond yield. When we met the last time the Bank of Canada met in July, this 5-year yield was at 3.4%. It was just above 3.4%. And currently, as you see, it's at 2.87. Now, the big decline that we saw today wasn't because of Bank of Canada easing. It was a direct reflection of economic data that were released today showing job openings in the US have fallen to their lowest level since January of 2021. And that caused traders to buy bonds, the safety of the 5-year yield, the 10-year yield, and that pushed those interest rates down. So again, this is very good news for a reduction in fixed mortgage rates, which is more closely linked to the market-driven 5-year yield than it is to the actual overnight rate. Now, there are 2 more decision dates this year. Next time will be October 23rd, and then they'll round out the year on December 11th. I've said now several times they will continue at each meeting next year to take the overnight rate down probably by 25 beeps each time, although you can't rule out 50 basis points if the economy slows further. This Friday, we'll see another labor market report, and the jobs reports are very important now because they do lead the economy, and we are certainly seeing a slowdown in the jobs market. Inflation as well clearly has downward momentum. It's happening all over the world. In Canada, the decline in inflation has actually been rapid and aggressive. And you see here that Canadian average core inflation versus the US has come down very, very sharply, much quicker than in the US. For a lot of reasons, inflation in Canada is on a downward trajectory. The labor markets, of course, are in excess supply, job vacancies down, corporate pricing behavior has improved. We also see helpful Canadian base effects in the next couple of months, meaning year-over-year comparisons will pressure inflation down. Wage growth is falling, but it's a lagging indicator. Retail sales have weakened. The savings rate in Canada is up to 7.2% for consumers. markets expect the overnight rate to fall to about the midpoint of the neutral range, which is 2.75%. And the renewals in mortgages at higher rates reduce discretionary spending, which slows economic activity. So the quicker that the Bank of Canada can get interest rates down, with the market rates driven by the weakness in the global economy, then clearly the sooner we'll see a pickup in the housing market, which has suffered as a direct result of monetary tightening. Now, the July housing market saw a dip in sales and a small rise in new listings, but it's really been a ho-hum summer season in June and July as far as mortgage originations go, as far as housing activity goes. You see in the first quarter, mortgage originations collapsed. I think as we move into the third quarter, as we are moving in, we're going to see the third and fourth quarter gradually see housing activity picking up once again. Now in July, and this is the latest data as far as national data are concerned, home sales have dipped month over month, well below the 10-year monthly average of home sales in Canada. This shows you sales activity for the month of July compared to the second quarter. And you see they're pretty flat. This has not been a very exciting housing market. New listings are edging upward, so more supply in the market. Housing markets are balanced across the country, some stronger than others, particularly in Alberta, but it is rapidly becoming a buyer's market in places like the Greater Toronto area as more inventory comes on the market and people are keeping the powder dry, hoping that interest rates will continue to decline. Year over year, the house price index has been pretty flat. It's still down a touch, but basically not much change in home prices pretty much anywhere in the country. Now, there's a great debate about mortgage originations, fixed versus variable. As I've suggested, interest rates will fall, but fixed rates remain above variable rates. And that's likely to be the case at least for the next few months. So at some point, we'll see more people move into variable mortgages, but over the past couple of years, 70% of new mortgage borrowing has been in the 1 to 4 year fixed rate space. So, and given the experience of seeing mortgage rates rise sharply, clearly home buyers may well be reluctant to take that risk right now. So lots of payment shock, which is causing downward pressure on economic activity as mortgages are renewed or refinanced, clearly at rates that are higher than where they were 3 to 5 years ago. Big story remains immigration. The federal government has finally come clean with us in admitting that the immigration numbers are distorting the economic picture. The growth of our population, which is really quite astonishing, Canada's population growth has hit a 66-year high at 3.2%. And the federal government has announced that they want to see a decline in immigration, particularly for temporary immigrants. Now, this is their planned permanent immigration figure. For this year, 485,000. For next year and the year after, that 500,000 number. There's talk that they might reduce these targets as well, but I doubt it. The numbers are dwarfed. These numbers are dwarfed by the influx of foreign students and temporary workers hoping to get permanent residency. The government has proposed caps on temporary residents. They already reduced the number of foreign students, and there's been a lot of talk about what exactly will be the net inflow of temporary workers. Now, the Bank of Canada was asked about the federal government's forecast numbers, and what the Bank of Canada has suggested is that population growth is going to be stronger than what the federal government is suggesting. So the Bank of Canada thinks that for this year, the growth in population will be 3.3%, which is, of course, extremely high. And as a result of that, the economy may not slow as much as some had been expecting. But the federal government says they'll come back in the fall and tell us more about what they are assuming for population growth as they give us their economic update. You can see that immigration certainly accelerated rent inflation, overall inflation as well, but Canada's population numbers has made a housing shortage even much bigger, much more aggressive than it was before. Rent inflation is now peaking with record low vacancy rates in residential real estate rentals. But construction of rental units is at a record high. So annual rent hikes averaged 9.1% in the past 3 years. But if you look at the past 5 years, as a result of the COVID lockdowns, you see that the 5-year average annual rent growth is 4.7%. So not quite as bad. But for all the initiatives taken at both the federal level and the state and local, or the provincial and local levels, we still have a very substantial housing shortage. And there's no way to meet the full demand imposed by the massive influx of new immigrants to Canada. So it would take 500,000 housing completions per year to meet the surge in housing demand. And we've never even seen half that amount in a single year. So this situation will continue. Historically, housing starts, we usually would see one housing start for just under 2 working age people, whereas now one housing start is supposed to accommodate almost 5 people of working age population. So again, I've talked about this a million times before. This is just an ongoing situation that's very difficult to correct in the near term. Also note that multifamily building permits dwarf the single family permits. You know, the big housing construction activity is occurring in the condo space and multifamily, whereas there's been a dearth of new construction in single family homes. So, and housing starts, though they've picked up, certainly we've seen what is for Canada's significant housing construction activity, it's still at the same level that we saw back in the late 1970s, with nearly double the population today. So again, inadequate. And dwellings under construction are high as completions have lagged. So we've got building permits picking up, we've got housing starts picking up, but those are both leading indicators. Under construction, very high, record high levels, but it's a slow process because of labor shortages, particularly construction worker labor shortages. It's estimated we need at least another 100,000 new construction workers. Most of them will be foreign temporary workers, and that's contrary to what the federal government says is their policy as we move into the next budget season. So that's a big problem. And the speed of home completions has lagged, largely because there just aren't enough people, not to mention the inputs into the production process, to complete these projects quickly. So, Eddy, that completes my formal presentation. It's a good news story in that inflation has come down and interest rates are likely to fall further, and market interest rates, not just Bank of Canada rates. But still, we've got a ways to go before we see equilibrium in housing demand and supply.
I think you said it, the lagging indicators, right? We know we're headed in the right direction, but it takes time. It takes, months, if not quarters, before all of this kind of sort of makes its way through the system. The rate decreases, the housing activity, the building, all of that takes time. And, it begs the question, Bank of Canada, why not do a half a point? If it's going to take so much time, you want to get to that 2.75, 2.5, because that's where we want to be. Doing it slowly, is it like, what are the advantages of that? Is it so that we don't go back into inflationary sort of numbers? Is it because you don't want to stimulate the economy too much? Like, why the slow play in your opinion?
It's because of the uncertainty. And if the US goes 50 basis points, that will certainly put more pressure on the Bank of Canada to do so as well. He was asked today about the Canadian dollar and if he's fearful that if they were to ease too aggressively, the Canadian dollar would fall. And though he also sidestepped the answer, he basically said, no, not important. And if anything, the Canadian dollar has held up reasonably well, given that we were the only North American central bank to cut rates. Right. And the US is certainly going to cut rates this month. So it won't take long before we see the full effects of the interest rate cuts. But, we missed the all-important spring season. And Macklin was also asked today whether he was concerned that home prices would rise if housing activity picks up. And his answer was pretty much no, that there's more supply in the markets than we've seen in the past many years. And so he's not so concerned about that.
Oh, that's good. At least he's in tune with that. He's doing his research. So because my biggest fan said I had a good question, I'll go to his question first. That's Jason Nugent, who spent some time on his holidays at the Bank of Canada. Not sure what he was doing there, but I'm sure he was helping us out in some way, shape, or form. So Jason asked, where do you think rates need to land to restore confidence in the real estate market?
Well, I think we're going to see that 2 3/4% overnight rate, maybe even 2.5%. Now, the question is, though, what does that mean for mortgage rates? What does it mean for the 5-year Government of Canada bond yield? Clearly those yields are headed for 2.5% also. So the overnight rate and the 5-year yield, kind of on top of one another, tells you the global economy is slowing.
Yeah.
Oil prices fell sharply today, and that's the reflection of weak global demand.
Mm-hmm.
So around the world, the economy is slowing. Canada is very interest sensitive, and our economy has already slowed more than the U.S. Interest rates may not be the driving force this time in a rebound. We need to see the unemployment rate stabilize and then begin to come down.
And history shows the correlation between unemployment rates and arrears are in concert.
Yeah.
And we're seeing arrears rise as unemployment rises. So the other thing, I was thinking about this, and I've been thinking about this a lot, is obviously we need disposable income into the economy to drive the economy, buy goods, services, et cetera. And as these rates and renewals come and they're higher and these payments are higher, it's taking out that spending from Canadians. So our economy is going to get hit by not only unemployment, but also, income that's going to mortgages instead of buying goods and services. So it's going to be interesting to see how this all plays out. Okay, let's get our questions because we have lots of them. The first or second one, because I did cheat and let Jason in front of the line, was from Matt Chan. Hey, Matt, hope you're doing well. Since our economy is so tied to the U.S., would the anticipated devaluation of the Canadian dollar create some inflationary pressure as the U.S. economy continues to outperform Canada?
Well, we've seen the Canadian dollar under downward pressure, and currently around 73 cents. It had been a bit lower. Yes, clearly our currency is subject to a downdraft, but it's not going to be huge. And the Canadian dollar's done quite well vis-a-vis the rest of the world's currencies. It's not so much that our dollar is weak, it's that the US dollar is strong. We're in an election season. We're certainly in a different election season than we expected as recently as 4 weeks ago. And it looks like it's a lot more competitive, and that in itself causes a good deal of uncertainty. And the political situation in Canada is in a state of flux also. So
today, absolutely.
Right. And the Conservatives would love to see an election this year. And countries in Europe and elsewhere as well have had elections or coming. So it's a lot of geopolitical uncertainty, and with major tensions in the Middle East and in Ukraine, Russia as well. There's a lot happening here, and that makes people nervous. So, jumping back into the housing market is, as much as so many people have pent up demand, they're going to have to feel confident about their jobs.
Yeah, absolutely. Let's go to the next question by Raul. Hey, Raul. Do you feel the 30-year term mortgages like those in the U.S. and Japan are a better system than what we have in Canada? There's a lot of talk around that. I know in the news they're talking more and more about bringing a longer term to Canada. What are your thoughts around that? Is it better?
Well, I think it's better because, just speaking as a homeowner, it's so much easier to plan because you don't have to worry in a few years interest rates are going to go up, and therefore you may not have the money you think you have for all the necessary expenditures. But the UK and Canada have long had these shorter term mortgages, and I find it hard to imagine that that's going to change, given that it would put more pressure on housing. And that doesn't, I mean, with the shortages in housing, I don't see that happening, but.
Fair. Okay, let's go with Ron Murphy. Hey, Ron, hope you're well. Do you foresee a break in the collusive behavior of the big banks by one or more reducing the current spread of 2.2 from the bank rate to prime rate? Yeah, I remember the days, Ron, you're right, when some banks would go a little more or a little less. But we've always seen that collusion since, I think you've stated, since 2013. Do you see that breaking finally? Will one try to compete and be a little lower than the other?
I think so. I think that there's less competition now that the Royal Bank owns HSBC. And so there is definitely less competition in the mortgage market, and that there's an opportunity for banks with the right appetite to jump in there and cut rates ahead of the other banks.
Yeah.
As well as cut rates even more than the other banks.
Yeah. Some of our charter banks also have a silly, their prime rate is not the prime rate, which is interesting. So just a word of advice, if you're out there shopping for your mortgage, it's a great idea to talk to a mortgage broker, because there is some disparities when it comes to prime. There is some, really good deals out there, and we can do all the shopping for you. So visit www.dominionlending.ca and we'll hook you up with a broker and they can help you with your shopping. Thanks, Natasha. Okay, next is from Angela. Hey, Angela, any chatter on government increasing the insured mortgage cutoff from 1 million to 1.25? I mean, this is such a great idea, knowing prices, especially in the GVA and GTA. Is that going to happen?
It should. I would have thought it would have happened by now.
Me too.
Because it's completely out of line with reality.
Sure is. Sure.
So what's holding it up? I'm not sure.
Yeah. Okay, next is from Croft. Hey, Croft. It's been a long time. Hope everything's well in Alberta. What rate do you see for the 5-year benchmark bond by the end of 2025? You mentioned that you're going to see more of an even between the bank rate and the 5-year rate. Where do you think that's going to end up? 2.5?
Well, yeah, around 2.5. It might even be lower still if we get to the target inflation rate and keep it there.
Yeah, no, fair enough. Next question is from Angela. What is your thought on what will happen in our economy if the canola tariff comes from China?
Well, that's another thing. I mean, why we needed to make an announcement that we were putting big tariffs on Chinese electric cars is beyond me, because you're just asking for reciprocal reaction.
Right.
And they're bigger than we are. So why do we want to get into this mess with them? We could quietly handle this situation.
Yeah.
Trade wars are not good for anybody.
No.
And they're not good for inflation. So it makes no sense.
Yeah, I think the idea is to allow electric cars being manufactured in Canada and the U.S. to sort of, push out the foreign sort of cars, and I get that piece, I do. But you're right, there is other ways diplomatically that you can do that. But there you go. Okay, our next question is mortgages by Mark. Hey, Mark, when do you anticipate the prime rate will fall below the bond yield? Next summer. I think we talked about that a little bit, probably sometime in the end of next year, middle of next year.
Well, again, it appears that the prime rate is moving pretty much in lockstep with the overnight rate. So if you have an upward sloping yield curve, which you normally do at a period without a recession, then you're unlikely to see bond yields below the overnight rate. The only way you get that would be big recession.
Yeah. Nicoletta asks about Alberta. It's funny, she says Calgary, but the affordability of that province has been sort of in the spotlight a lot of migration from other provinces that with BC and Ontario, but obviously immigrants are looking for that reprieve in house prices and payments. And Alberta has been the benefactor of that immigration. Where do you see the interprovincial migration head towards? Is it going to be more about Alberta? Is there going to be some differences, with employment? Like, what's happening in that?
Well, the real push is probably behind us, particularly if the global economy continues to soften and oil prices remain low. But I mean, there's been interprovincial migration to the East Coast as well because of much lower home prices. But as long as the jobs are in central Canada, it's hard to see a dramatic further movement. Clearly, demand for labor is significant across the country, and to the extent that there are many businesses that want to take advantage of low-wage foreign workers, there'll be incentives for immigrants to move beyond the GTA or the GBA.
Which is a good thing. I mean, you want to spread them out for sure. Obviously the population, they seem to gravitate to where there's jobs, which makes sense. I mean, you need the means to support your families and make those payments. So it makes sense. But yeah, we'll keep an eye on that one. Next question is from Carlos. Hey, Carlos, hope you're well. He's talking about the major change in mortgage landscape. Anything that you see that'll change a policy or maybe the benchmark rate? Is there like the stress test? Is there anything that you foresee may change to either help or hinder the economy?
Well, I don't think they're going to ease the regulatory environment, and particularly so given that mortgage arrears are rising. And so they don't want to see explosive growth in housing, and they don't want people who can't afford it to get into homes and get in over their heads. So given the affordability issue, it's hard to imagine that that there isn't a constraint, both in terms of loan loss provisions and considering mortgages to be higher risk than they were before, and therefore having to for the financial institutions to hold money in capital rather than in lending it all out. The OSFI has raised the capital requirements repeatedly over the last year.
Yeah. I have a question around the GDP gap, because you said hasn't been this wide since 1965, is what you said. So we've had a lot of years where we're sort of lockstep GDP numbers with our biggest trading partner, the U.S. Like, that can't be good. I mean, there's got to be what are we missing here, Sherry, in that gap? Like, what is there something that no one's talking about? Because if it's been since 1965, a lot of years, and I wasn't born in 1965. I know I may look it, but I'm way younger than that. Either with you, by the way, just so you know. But this can't be healthy. Like, what is it going to take to bring that GDP back together? And what is the fallout, or what is the issues that's going to cause in your mind?
Well, the U.S. has the advantage of much stronger productivity growth. And we could debate forever what the reasons for that. But Canada doesn't invest as Canadian businesses don't invest as readily in advances in technology and as quickly. There's much more competition in the U.S., which forces businesses to respond aggressively. In addition, having the stability of a 30-year fixed rate mortgage loan makes a big, big difference. And if you stay in your house for a long time, the mortgage payments, which are tax deductible, become a smaller and smaller portion of your overall required spending, non-discretionary spending. The U.S., just the size of the U.S. marketplace is an advantage in that, because there's more competition and more labor, there's just the possibilities of being at the leading edge of whatever the newest, advancement is in pretty much everything.
But I'm going to put a big but on here. But like since 1965, our productivity was in lockstep with the U.S. Like now there's this gap. So
no, we've had lower productivity than the U.S. for a long time.
So on a GDP basis, though, we are.
Well, GDP per capita
So our productivity is less. So that means that, as a nation, we are not, per capita, so per working individual, we're not as productive as the US and probably many of our European counterparts as well. Like that's got to be a problem. That's jobs, that's investment, that's R&D, that's all those things that drive an economy and drive a healthy economy. And we are now, deviating quite substantially from our biggest trading partner. Like that cannot be, good for Canadians, good for Canada economy. So maybe there's something I'm missing. I don't know, but I don't like to hear that, out of the G7, we have the worst productivity. I don't like to hear that, we're not investing in companies and, we're not, ensuring that, the dollars are being stretched as much as our trading partners. Like this is a concern. And I hope the government is taking this seriously and looking at, trying to help these businesses be more competitive, trying to help these businesses, with their business. So, it's glaring to me, and I know that it's not good. Okay, we'll get to one last question. If you have any more questions, please send them through. This one's from Asan. Home shelter inflation should move down from existing 0.7%. What do you think this shelter inflation should go down to invigorate the housing demand?
Well, the inflation that's coming into the CPI, the biggest component is the mortgage interest. And so the very fact that the Bank of Canada raised interest rates to slow economic activity and fight inflation is counterintuitive to including mortgage interest in the CPI. I actually think they shouldn't include mortgage interest in the CPI, and the CPI would give us a much better read on the overall level of inflation if that were the case. But everybody knows that taking out mortgage interest, you end up with much lower inflation. And once the psychology begins to shift, people buy homes not because, well, for many reasons, but importantly, regardless of whether mortgage interest is in or out of the CPI, when mortgage rates come down, housing demand is going to pick up. And by definition, we've got more housing supply because of the new listings. There is some construction as well. And I think activity will pick up.
So, it's funny, you this glaring number of you take 500,000 new dwellings every year. We won't keep up, even if we did that for years. And obviously we're not even close to that. So, right. So when rates do come down and there's that equilibrium and people start buying again, we're going to go back to multiple offers, higher. It's so interesting. It's almost like we're in a
video. And so there will be buyers who want to jump in before that happens.
Yeah. And listen, that's the way to do it. I mean, you buy low, sell high, right? That's the ultimate scenario. And of course, as you buy low, you are going to have, if you have a mortgage, you're going to pay a little bit more, but timing that. And that's, again, having the advice from a mortgage broker is so key.
Right.
When you're going through those scenarios. And of course, we can help you at dominionlending.ca. So, Well, let's leave it at that, Sherry. I just want to say, you know, I thoroughly enjoy these calls with you because you're so good at it. I mean, as you're going through your presentation, I'm glued to the screen. I know all of our viewers are too. We so much appreciate you, Sherry. Again, you do such a great job. So on behalf of all the DLC mortgage brokers, owners, and agents, we wanted to thank you for doing such a great job for us. And for everyone that's tuned in, thank you. We really appreciate it. You know, coming on live is really important to us. I know we have a few hundred, but thousands of people watch this on recording. Please feel free to reach out to Sherry and I anytime. We really appreciate you. The next time we're on will be in October, which, as Sherry suggests, there it is, October 23rd. As Sherry says, it will be another decrease quarter for sure, half, who knows? I think you said there's a couple of economic things that are coming out in the next few months. So we'll see how that goes. Thanks, everyone. Really appreciate you, Sherry. Always a pleasure. Thank you, FDT. We love you guys. Take care, everyone. Bye-bye.
Bye-bye.